Hi traders, this is Martin. Why don't you come and join me down on this beautiful beach here? The temperature is hot, the water is nice and cool and refreshing, and we're just going to have a great day. But hey, guess what? We discovered a sign on the beach. It says shark, swim at your own risk. And guess what, guys? That means stay out of the waters, and that's too bad. So this video is all about when not to trade, okay? And thank you very much for joining me. We're also going to look at the free trade signals I had given out last week. So the important thing is I want you to be clear. There are countless traders who are trading, not because they want to, but because they have to. Why? Well, they're addicted to trading and they're spiraling out of control. They're undisciplined and can't say no to trading when the market conditions aren't right. Just like the sign here telling us that the conditions for swimming are not that good. So beware. The big lie is that you become rich trading Forex. Yes, you can make good money, but only if you trade within a well-disciplined plan that protects your money first, even before you can make money. But that's only half the story. You also need to know when not to trade when the market conditions are telling you to stay out. I'm going to share with you 4 ideas and tips to help you see the warning signs telling you the dangers ahead. Sharks in the water. This means you don't trade right now. Maybe it's better just to wait. And as always, we'll look at this past week's trade signals and see how well we did. Okay, guys, once again, thanks for tuning in to this video, and I hope that you liked my introduction. This is me right here, and I'm the originator of the ABC Free Forex Signals, and all you have to do if you want to receive my free signals without any obligation, to send me your email address with your name. Let me know what country you're from, and I'll put you on my VIP list. Okay, so again, just a bit about me. I'm a proud Canadian trader, been trading for at least 7-8 years, and I put together a terrific program, especially for the new beginners or people that have had lots of problems trading Forex in the past. And guys, I'm going to put you on the easy street towards making money. It's a very simple process. All you have to do is just follow my instructions, guys. And again, if you want to send me an email, you want the free signals, here you go. Send it to mskyj007@gmail.com. Okay, so I'm going to repeat this a little bit later, but first, we're going to look at some charts in just a moment. We're going to look at all this week's past trading signals, guys. And before I do that, as always, I want you to pay attention to my humble disclaimer here. My free signal service is an educational program only. I'm trying to teach you how to trade correctly and not give you any specific investment advice. Now, it's your responsibility to evaluate the relevance of my advice and content. Don't blame me if you lose all your money. You probably weren't paying attention to what I'm teaching you, and you're not following my instructions. Since we're trading with real money, right now I only advise you to risk a maximum 1% of your account balance, right? And for new traders, please trade on a demo account only for at least the next few months so you can get the hang of my system, so you can get used to it and understand exactly what we're doing here. Okay, so we're now going to switch and take a look at last week's review. Guys, these are all the signals I had given you last week, and we're going to start off by saying we had 2 held over signals from the previous week. So on June the 9th, I sent an email basically advising buy the US Japanese yen, okay, and we held that over the weekend till this weekend. And guess what, guys? It was a winner, and it was a huge winner for approximately 109 pips because it reached not only the second take profit level, but also beyond that. So we're going to look at the charts, and I'll explain exactly how I worked that out, okay? And on June the 10th, also of the previous week, I did send out a signal, sell the euro British pound here. It was held over over the weekend, over the previous weekend, and guess what? That was a loss, but we did limit our loss to only 40 pips, okay? It did hit our stop loss, okay? And on June the 14th now, that's the beginning of this week, guys, I sent out an email, and by the way, how you get my free signals is through my emails. It's really simple. You just got to keep watching your emails, and they're normally sent out New York Eastern Standard Time about somewhere between 6 and 7 p.m. Eastern Standard Time, okay? So I sent out a signal by the Australian Japanese yen. That was the first trade of this week, and guys, that was a loss. But again, we limited our loss to only 31 pips because it actually crossed over our dominant trend line. That's what the DTL stands for. So it was automatically stopped out. Okay, guys. And on June the 15th, the next day, I sent out another email, sell the Australian dollar versus USD, US dollar, and that was a big winner for approximately 74 pips. It did hit the second take profit level and went beyond that. That's what this plus sign means. So I've introduced this into the trade summary, guys. So when you see a plus side, it actually went further than the second take profit. Okay. June the 16th, I issued a euro British pound. This was basically kind of a clue. It was not an official signal or anything like that. But guys, a lot of you sent me emails telling me you took the trade. So I'm counting that. I'm counting this as one of the signals, guys. It was a winner, again, for 32 pips. However, it only reached the first take profit level. And then on June 17th, there was another real signal, sell the euro British pound. Again, it was in conjunction to this one. So here I was looking for a trend continuation to the downside. Price has reversed, and we're going to look at the charts in just a moment, but we're holding it over this weekend. So we're going to see what happens Monday, Tuesday to this trade, okay? So over the past week, if you had taken all the trades, you would have won approximately 144 pips, and that is discounted. That is taking away the losses here. You can see 40 and 31 pips. So the wins minus the losses, and again, a pretty good week. And I know some of you are maybe not kind of paying attention, but generally we have a lot more wins than losses. And guys, the idea of my free trade signals is to help you simply just follow my instructions. You're going to make money, and you don't really have to think about anything else, and you're not going to be under stress. And that's the whole idea of this program. So let's take a look again, June 9th, the June 9th that we held over the weekend, USJPY. Okay, let's take a look right here. And you can see, here's the information, guys, right there. You can see this is when I send you an email, I give you the new signal by US Japanese yen. It was on June the 9th. And I give you the entry level right here, you can see, and I give you the first take profit, the second take profit. So again, looking at the charts, okay. So here was the entry right here. You see this vertical line. So that was the entry. There was the signal right there, and we decide to go long, or we're going bullish, or we're going up. It doesn't matter which words you use. And anyways, the next day went down, and specifically I said on the next day, because I do provide the email updates, and I said do not sell, keep it open, and you can see on the next day it went up and up. It's and here we'll talk about this vertical line, because here was another entry. We'll talk about that in a second, but basically looking at price here, not only did price hit the first take profit right there, and if you were to hold on to your trade, or like with the second position, it would have hit the second profit with this candle as well. So here's the entry again, guys. There's the entry we got in right there. Okay, right there. This was the stop loss, the original stop loss right there. Okay, at 108.89. Okay, so now Then I issued another signal. Well, it was kind of, I basically said, and you can read this right here. I will also be adding a small position to the previous trade signal, which was the US Japanese yen, as I believe it's still going to go higher and hit our second take profit level 110.26, right? So on this particular day right there, and at that candle, okay, I issued another, wasn't a real official signal, but I did say, and in my clues, guys, and it depends on how you read my information, and if you're paying attention, right, I did say I'm going to be adding another small position to the previous, to this US Japanese, and guess what? From here, it went right up there, guys, and I mean, look at that. That's a monster move right there. So at the end of the day, or when you got home and you saw this candle here, you had the choice of closing the trade. I believe I suggested to close it anyways because I believe price was going to reverse after that. But take a look, guys, from here's the original entry all the way up to right there, guys. That was a huge, huge monster move. And congrats to all of you who actually picked up on this second trade right there and added to your position or took a new position again, and I'm glad you got in there and you were well rewarded. Okay, so let's get on to the next chart. Okay, and on June the 10th, and that was from the previous week, again, this is another trade that was held over. Here's the signal, guys. It was a sell Euro GBP, okay, and you can see we got in, let me just, okay, so here was the signal, okay. We got in right there at the entry 0.8588. That's right there. Price just went down a little bit, didn't quite reach our first take profit of 0.8564. Price reversed right over here. I issued a signal saying keep the trade open. Price then reversed. You can see this with this white candle above this line. You can see that line. That's the DTL line, okay? And with this white candle, it reversed, crossed over above this line, and automatically, that's one of our rules, guys. When we see this happening with a reversal candle, we've got to close a trade to protect our money, which is the number one rule in trading. Always protect your money, because from here, we don't know if price is going to go higher, right? And if price goes higher and we still haven't closed a trade, you guys then would be losing big money, right? So we want to limit our losses. Now, of course, on the next day, it went down, and again, because the markets are a little bit wonky, guys, and so this is what's happened in the meantime, okay? We have more on this in some my further trade signals, but let's just take that off. So here, this was a loss. The summary of this trade, it's a loss, and the lesson is we limited our loss because price did close above the DTL line, right? That's really important, okay? So next, we're going to go to right here, okay? And this is the buy Audi Japanese yen. So on June the 14th, I sent you an email and instructing you that I was going to take a, well, I don't actually tell you I take the trades, but listen, guys, and I mentioned this in previous videos. Every signal I send out to you, I do personally take. Every single signal. So I'm doing what I'm telling you to do, and that is to follow my instructions, take my signals. Okay? So right here you can see. Okay, once again, this is the signal I sent out to you guys right here. It was the buy Australian dollar versus the Japanese yen. Here is the entry right here. Okay, just want you to know right there. I'm sorry, this is the signal right here. Okay, so here's the signal. Our entry is right there, and I expect the price to go up. And guess what? The next day, it actually, there was a black reversal candle. It did kind of cross over the DTL line, and I issued an update telling you to get out of the trade. Okay, so we automatically closed the trade right here when we saw this black candle cross back over the DTL line, and guess what? again, the lesson is we limited the loss because look what happened the next day. From here, price went down to here, price went down to here, price went down to here. And how many of you in the past, you opened up a trade and price went against you and you kind of were too afraid to close it, or you didn't like the idea of closing a trade because you hate losing money, and you kind of said to yourself, or you're hoping that price would eventually go in your direction, right? And guess what? Every time that happens and you don't play with specific rules, you get burned. And in this case, look at this guy's price went right down, down, down. And if you would not have closed your trade and kept it open for whatever reason, you would have lost some really, really big money. Okay, so anyways, the summary here's and the conclusion is that you should always close your trade, especially when you have specific rules to close your trade. And in this case, this was a loss, but again, we minimize the loss. Okay, so let's see if we can get back on track and have a winning trade. Okay, here on June the 15th, I said sell the Australian USD, guys. Here's the instruction, the entry. Okay, you can see 07686, which is right there. Okay, right there. Okay, there's the signal, by the way. This kind of candle, when you see it really small, retracement candle, I call this a resting candle. I expected price to go down, and guess what? We got in right there, and price did go down in a big way, and it did reach our second TP level, which is right there. Plus, it went beyond that right there. Okay, so you would have made some really good pips. Congrats, guys, to everyone who took this trade. This was a really, really nice winner. Okay, and we're moving on. Let me just take that off. Okay, now we get to the next trade. Okay, so this was a sell euro British pound, guys, and this was the one where I basically said not in my instructions, but in my introduction on the email, I am also looking at a sell euro British pound, but it's not a recommendation or a signal. However, it doesn't say don't take the trade. So often I'm going to give you clues in my emails of what I'm looking for and what I feel really excited about. Now, in this case, I did already give you another signal, but I don't want to give two signals at the same time. But in this case, I said I am also looking at the selling the euro British pound, and if I'm adamant about you not taking the trade, guys, I want you to pay attention. I will tell you in the email, do not take this trade, even though I'm looking at it or I'm interested in it. But in this case, I did not say anything like that, and it was something I was very interested in. I took the trade personally, and let's take a look, see what happened. So here is on this date. Here's the signal, guys, right there. Okay, that's when I said I'm looking at selling euro British pound. Guess what? It went right down to there, and that would have been a winner as well, guys. It did reach the first take profit level. You can see with this black candle, 0.8544, did not go down further to the second profit level, but it did hit our first take profit level for some pretty good pips. And the next day it has reversed. Okay, with this candle, you can see it's still below our DTL line. And guys, I want you to keep this open over the weekend, which this video is being produced on a Saturday, so we're already into the weekend. But but again, hopefully you kind of understood that because price had not crossed this DTL line, you would automatically just keep it open, especially if this was on Friday, on the last trading day. So that's what we're going to do. We're going to wait to see what happens on Monday or Tuesday. I kind of think price is still going to come down further. We are in a kind of a downward channel, okay, and by that I mean, okay, so see, we're making lower highs, and here. Okay, so you see we're kind of in a downward or pennant. Okay, and I think price from here is still going to come back down, and then eventually may break this zone, come down further, or go back up higher. Okay, so that's what I see here. Again, congrats if you took this trade, if you took my clue from my email, and again, this was a good winner. So again, thank you very much. Okay. And now we're going to get on to the specific lesson, guys, and just a second here. So here is the specific lesson. Okay, here's the lesson I want to talk about. Basically, it's 4 simple ideas giving you the warning signs when to stay out of the markets. And that's what the important thing in this video is all about. So when not to trade. Okay, so here again you can see we're on the beach. There's a big sign saying warning, shark sighted, enter at your own risk. Okay, and guys, if you were on the beach with me, we would not have gone into the waters, no matter how beautiful and warm the temperatures are and how inviting and refreshing the water is. But you know, we're not going to take chances. So these are the warning for the non-ideal market conditions when you should really stay out of the markets. So number 1, whenever there's a tight range or sideways market, we really want to stay out of the markets or be very cautious if we enter a trade. And the reason is, guys, because we are kind of swing traders. We're trying to trade with a trend, trying to trade with momentum to the upside or to the downside. So we kind of don't our type of trading does not suit this kind of condition. Okay, so right now I'm just talking to you about the different conditions. Number 2, markets are converging or the contracting. That means all the currencies, there's no real major strength in any currency. They're all kind of weak, all coming together. So it's hard to trade one currency against the other, and that makes it really difficult. Number 3, we have a non-trending price action. So when you look at your chart, you actually see that there's not a trend in place. There's not a bullish uptrend or a bearish downtrend. I'm going to show you how to identify that very easily. We look at steps. Okay, we look at price action steps or the lack of steps, and I'll explain what that means in just a moment. And number 4, unexpected volatile price movements, right? I mean, traders, we do like a bit of volatility in the markets. We don't like flat, non-volatile markets. We like trending markets, when price is actually moving in one direction or another. But there are times when we really have to be cautious, and I'll show you how to kind of look out for that as well. Okay, so the very first thing, we're going to talk about the tight range or the sideways market. And one tool I'm going to suggest you can do and look at, and we're going to have a look at that in just a moment when I open up some charts, is to use the Bollanger Bands. Okay, the Bollanger Bands to show you a very tight squeeze or a flat market versus a trending market. And it's important to distinguish between the two, between a trending and a flat market. Okay, so we're going to look at some charts, and I'll show you how to use the Bollanger Bands in a very simple sense. This is not a lesson on that at all. Okay. Okay, guys, you can see I've got the Bollanger Bands here. Okay, I've got, and I want you to take a look at this. So, market is kind of sideways here, but look at the width of the Bollanger Bands, and then take a look right here in this area. Do you see the tight squeeze? The bands are so tight together, and when that happens, it's really difficult to trade. You don't want to do that, but at some point, then the bands expand. You can see that right there. Okay, so the bands start moving wider, and once that happens, we start getting into a trend. So we're kind of looking at this currency pair. We're basically saying it's breaking out of. Okay, so maybe I'll use another tool. So breaking out right here of support, okay, breaking through support, and then finally moving in a big, big way, okay? So, and then once you see a candle right there, like with this candle, let me just do something else. Okay, So this candle here touches the bottom band, okay? And once that does that, that's usually a pretty good indicator price will continue in the direction. And in this case, it did go down further, right? And then at some point, price will reverse back up to the medium center line, okay? So the medium line of the Bollinger right here, you can see it's the 20 moving average, simple 20 moving average, okay? And these bands are just a deviation, two deviation above and below the 20 moving average. Okay, so this is what you want to look out for, guys. And when you see that, you want to kind of stay out of the markets or be ready for a breakout or a continuation of a trend. Okay, let me just do something. Let's move along. Okay, and you can see here again. So when price hits the upper band, you can see it's expanding. These bands expand. And when that is, that's always good for trading, right? Price comes back down, bounces back higher, and continues going higher. So that's what you want to look for. But I'm just looking at this pair. Okay, I don't see too many other flat markets. I'm gonna change the currency pair to let me see, this is the Australian New Zealand dollar. So we're going to go to Euro Swiss franc. Oh, okay, guys, this is the Euro Swiss franc. Again, you can see the bands are expanding, which usually means price is moving in one direction, in this case down. This candle here, price hit the lower band, and you can see it continued going down. Then price comes up again, and all of a sudden we get into the sideways market. And take a look at the bands, the upper lower bands, right? Right here, they kind of act as resistance and support. But then all of a sudden, let me just do that. All of a sudden, we break out, okay? We break out again. Right there, candle hits the lower band and we continue down. So, and once that happens, the bands are wide again. Okay, so the bands continuously expand, like right here you can see. Okay, let me just move that. Okay, so they either expand, which means they're good trading conditions, or they get sideways here. The bands are close together. And you want to stay out of the markets when you see this as well, right? Especially if it doesn't coincide with some of your other trading indicators, right? So again, let me just go backwards here. Okay, see here again, you can see right there. Look at that, guys. Okay, so that would be really difficult to trade. Okay, and right here you can see how closely together the bands are. They're really tight. So when I say difficult to trade, well, basically price is just moving sideways, like up, sideways, up, down, down, up, up, up toward the top band, down, 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 and then there's a breakout right here. Well, not just yet, but okay, right there. So anyways, you want to stay out of that. But you see, take a look right here, guys, at this nice expanding Bollanger bands right here and here. And you see again, price hits the top of the band just as it's expanding. Right there, the candle hits here and then just continues to go up, okay? And as price continues to go in one direction, the bands continue to expand, okay? So let me just go backwards for a second. And again, look at this tight range right there. Okay, look at that, guys. You can see it would be very difficult to trade this until we get the bands expanding, okay, and price goes up, okay. But here, price is just up, down, up, down, sideways, up, down, sideways. There's absolutely no way you can trade in conditions like that. So anyways, guys, that's the Bollanger Bands. You can use them. They're a standard indicator. You can find them on the internet anywhere. I believe even they come with your charts. Bollanger Bands. And then you can change the color and the width of the bands. Okay, and so you can put them on your charts if you want, and that'll help you see when not to trade. Okay, so let's go on to the next thing. Okay, the next market condition, which kind of gives you a warning sign to stay out because you don't want to be eaten by the sharks, right? Is this one right here. Markets are converging or contracting. In this case, you can use the currency strength meter. I use this all the time. It's one of my main tools, okay? And we're going to take a look again at the currency strength meter, and I'll explain exactly what I mean when markets are converging and or contracting, okay? Okay, guys, take a look here. This is the currency strength meter I'm using, and you guys may have the same or slightly different one, but it's very easy to see. Now, this is the daily charts, okay? So it's the daily candles, and it's showing me the strengths of the individual currencies. It's not the strength of currency pairs, but individual currencies. So that means each line here represents a different currency. So this green one, just to show you, is the Swiss franc right there. This red one, which you can see is rocketing to the moon, showing tremendous strength coming in for the US dollar. This kind of purple pink one right there, guys, that's the Japanese yen. This yellow one right here coming down, down, down is the New Zealand dollar. This orangey one right there, you can see coming down, is the Australian dollar. Okay, this here is the CAD. It's the kind of the very bright, like light orange. That's the CAD. This blue one here is and it's starting to reverse, is the euro. Okay, so we're talking about the actual strength of an individual currency, but I want you to pay your attention to this area right here. You can see all the lines came together, guys. Uh, the strongest line was here, the weakest line was here. Okay, let me just take that off. So you can see again, just like the Bollanger Bands, this is indicating right here that there is no strength in any individual currency. They're all contracting. The markets are contracting, and you want to, for a few days, you want to stay out of the markets and maybe catch a breakout from one of the currencies. So from here, you can see this really tight contracting or converging market. You see what happened here with this green line, that's the Swiss franc. So then this would have given you a good clue to trade the Swiss franc. Again, let's say the yellow line here, which is the New Zealand dollar. So right here, Swiss franc coming out of this contracting market, and this yellow one is the New Zealand dollar. Okay, and then from here, you can see all the currencies expanded. Now they're really expanded. So hopefully the trading conditions become better. And again, it's important to know when to kind of stay out of the markets and perhaps when to get back in, which is just after this contracting market. Now I'm going to move back a little bit further. You can see, and we're going to look at, we're going to see if we can see anything else. Okay, right there, guys. You see this hole here? And this was back in January of last year. Okay, again, that was the date below. But right here, this would have been a terrible time. See right there? That was a contracting market again. And then right here, it just, right there, guys, look at that. This was in February of 2021. So again, the market conditions got a lot better. Okay. And again, contracted right there, February, the end of February, March. Okay, right there. This was a bit crazy here. April, beginning of April. Okay, and then things got better in May of this year, and now they're contracting again. This is when we had some problems with trades. We had some losing trades again. So this was at the mid to the end of May in this area. Okay, and now looks like some of the individual currencies again are moving in a specific direction, and the strongest one being the US dollar, the weakest one right now being the New Zealand dollar. Okay, so that is market condition number 2. Okay, here is market condition number 3, non-trending price action. Again, it's kind of, we're saying it's similar to a flat or a sideways ranging market, but I'm going to show you how to look at your charts to simply identify a trending versus a non-trending market based purely on price action. Okay, so for this, all you have to do is you want to just look at your charts for the non-steps. So we're talking about steps. What do I mean by steps? Well, I will show you right now. Okay, we're taking a look at the British pound, Swiss franc, and we're going to look at steps to see if we can identify a trending market. So this is the British pound, Swiss franc chart. It's the daily chart, so all these candles are daily candles. And back over here, you can't see it, but back over here was a previous high. Okay, just back a few more candles. It's not showing you on your screen, but then all of a sudden price, let me just take that off. So price goes higher and right here makes a new higher high. Okay. And then price comes back down, makes a new higher low. So here we can see in a step pattern, this is the previous low. This is a higher low over the previous low. This is a higher high over the previous high, which I indicated just a moment ago, right? And you can see price goes up, price goes down, price goes up again and makes a new higher high. Here's the previous high. Price comes back down right here, makes a new higher low. Here's the previous low. Price goes up again right there, makes a new higher high to the previous high, and then so that's what we mean by a step pattern. When you can see this, like a step up, step down, step up, down, up, but each step is higher in progression and each lower step is higher in progression. So this would be a proper kind of a definition of a uptrending pattern. And when you see this happening along perhaps with some of your other indicators, and even I've got the Bollanger Bands on here, you can see it makes it a lot easier to trade because you can actually identify an uptrending pattern, right? So let's just take that off and see if we can if we can look at another chart. Okay, I'm going to come back to this chart again, the British pound, Swiss franc. You can see here, so price is kind of in a sideways pattern, but the opposite is we don't see a trend. It is actually very difficult to trade into this type of market condition. So you can see price goes up, okay? So it is making a new higher high. Here's the previous high. Price comes back down, okay? It does make a higher low to the previous low. So far so good, but now look what happens. Price goes up again, does not make a higher high to this previous high. In fact, price comes down and is actually making a new lower low to this low. And then price goes back up again. And guess what? Right here, again, it's the same height as the previous two highs. So it is not a new higher high. It's a triple high here. Guys, price comes right back down again. It does make a new higher low to the previous low, but here now price goes up. Doesn't even quite get up to the previous high. So, and you can see it's just going sideways here. Again, this low is the same pretty well as the previous low here, and then starts going up again. So again, there's no step price action here. Step means that once it goes here, it makes a new higher low, and then it should break out and make a new higher high, new higher low, and then higher again, new higher high to the previous high, new higher low. This is a proper step market price action, which identifies a trend when we feel comfortable getting in. But when you get this kind of a mess right there, guys, just going up, down, and not really going anywhere, there's no steps, and guys, that's when we want to stay out of the market. Okay, so hopefully you understand what I mean by that. And then finally, we're going to come to the last market condition. Okay, so the last market condition which we want to stay out of is unexpected volatile price moves. Okay, now this one's kind of a tough one because I mean, volatility can come into the markets at almost any time. I mean, there could be some very negative news from somewhere around the world, or something terrible has happened, which creates some huge volatility in some of the currency pairs. But basically, we can expect some volatility when we use the Forex factory calendar for important news. Okay, and this is important, okay, guys, for you to understand. And the what you normally get is just a few days before some real volatility is expected because of the news. And in this past week, we had the FOMC news event, which propelled the U.S. dollar really high. So U.S. dollar gained a lot of strength, and the other currencies gained a lot of weakness against that. So it wasn't totally unexpected, guys, but I'm going to show you the Forex factory calendar. And sometimes you need to maybe be cautious and stay away from the markets if you know in the next couple of days or the next day there's going to be a high event news that could impact your trade entry. So again, this is number 4, guys. Okay, and let's take a look. Okay, all you have to do is go to the website here. You can see forexfactory.com/calendar. Okay, and when you do that, this pops up in real time, and it's always updated, okay, instantly, so you can see the important news coming out from Monday, June 14th, June the 15th, Wednesday, June the 16th. And on that particular day, you can see here, I'm scrolling down. On Wednesday was the FOMC, and just a second. Okay, you can see right here the FOMC economic projections. Now, notice that these flags, these little flags, they're all in red and orange, and there's a filter on the top right side. I've turned the filter so that I'm only interested in the most highest impact news, which are red flag. So red or orange, I'm not interested in anything else. Otherwise, this calendar would be filled with many different types of economic news that is coming out all the time. So if you want, go to the top right-hand corner of this website, go to the filter and just click on, you want to see only the news events that are red or orange, okay? And the information comes out right here. You can always click on here to open the file to see what this important information means. And basically anything that's red flagged, okay, like here the FOMC statement in that, and that you kind of possibly want to stay away from the markets just before. Now, again, if you're totally a conservative type trader, then you probably will find every excuse to stay out of the markets rather than engage in the markets. So hopefully you're not too super conservative, because you really need to be a little bit, sometimes to make money, you need to be a little bit more aggressive. But I'm just telling you that you can always go to forexfactory.com to stay ahead of the news, especially the most important news events. Okay, and so that takes us to the 4 market conditions and when you possibly should stay out. As you trade longer and longer and become more experienced, you'll look back and perhaps become a little bit more adept to understanding when to not trade, okay? And when you're just beginning, you probably can't keep all of this straight in your head, and I don't blame you. I mean, there is a lot to learn, but my whole program, the free signals, is to make things as easy as possible for you. If there's anything really important, I will certainly let you know in an email update or whatever. But basically, just follow my instruction, guys, and don't make trading complicated. So again, we're near the end. If you want to receive my free signals, and if you want to receive them and be put on my VIP list, right? I'm going to send out every free trade signal whenever I can. Usually they're 3-4 times a week, only once a day, okay? And if you want to be on my VIP list, send me your email. Send it to right here, mskyj007@gmail.com. So mskyj007 gmail.com. Okay, guys? So hopefully you enjoyed this video. Hopefully you learned a little bit more. I'm not trying to teach you too much at one time, guys. It's not that important. And again, cheers from Canada. Okay, cheers. I'm really happy. The weather's really great here. And don't forget to subscribe if you're a brand new subscriber. Hit the subscribe and the bell. That gets the YouTube videos right in your inbox. But especially, guys, if you like what I'm doing, you like what I'm teaching you, and you're learning something, please, please click on the like button. It tells me that I'm doing a fair enough job, that I'm reaching out to you. And again, guys, it helps me to understand that I can move forward and continue to teach you. So click on the like button. I'd really appreciate that. Once again, till next week, take care, and we'll talk to you again soon. Bye for now.